Welcome to It Depends, a sales tax podcast by Tax Connects. I'm your host, Brian Greer. Sales and use tax can be confusing and very overwhelming, but it doesn't have to be. Whether you work in industry or at a CPA firm, or just someone who wants to stay informed about the latest sales tax laws, we've got you covered. Periodically, we'll explore different aspects of sales tax. So whether you're a tax pro or a novice, tune in and join us as we attempt to simplify the complexity of the sales tax world. This is It Depends, because with sales tax, there's rarely just one answer, and often that's our answer to many questions. It just depends. But just kind of a quick intro of myself and Jeff, Tax Connects, just a quick little commercial here for you. We focus very specifically in the sales tax arena. We're about a 100-person firm, focusing really on two different practice areas, one of those being the consulting and advisory side of the business, which is really helping companies identify where they have Nexus, where they have a sales tax obligation. Basically, what are their rules and responsibilities in terms of managing sales tax within their business? And then the second piece of our business is a compliance outsourcing service, where we essentially act as an outsourced sales tax department for our clients operating in multiple states. So with that, we prepare and file the returns, remit the payments, manage the notices, just kind of take that administrative burden off their shoulders. Now, Jeff and I, we've worked together for probably 20 to 25 years. Been a long time, feels a lot longer than 20 years.
Way longer.
Jeff's been in the industry a little bit longer than that prior to myself, but we've worked together here for about 15 years. We were both at Thomson Reuters for a good bit, and then a predecessor company called Tax Partners, where we worked together as well. So let's kind of jump in here. These are some of the topics that we had scheduled to go through here today. Some of these we just pull these from questions that we get in conversations that we have, but you can see them here in terms of these retail delivery fees. We're seeing those pop up in a couple of different states. We're seeing some changes from a economic nexus perspective and how states are adjusting their requirements. Sales tax rate, always something that's changing. Maybe not necessarily always at the state level, but there's always local changes. And then NFTs, again, we've gotten a lot of questions about these over the last few months, so wanted to have a short dialogue on that as well. So with that as the intro, let me turn it over to Jeff here for the first topic.
Thanks, Brian. So, as Brian said, this is usually a fairly interesting discussion. Some years are more interesting than others in terms of the scope of changes that we see that are significant or impactful to the primary industries that we serve, and most likely the industries you guys are part of. I think some of the ones that we're going to talk about today are a little bit more unique than what we've kind of addressed in the past. There's some good news in here, and there's some not so good in here. But let's kick it off with the first item on the agenda, the delivery fees. And last year, you would have heard us talk about Colorado's delivery fee, or maybe it was even the year before that. So that one has been in place for a while. And essentially what that is Colorado instituted a fee on every delivery of tangible personal property in the state that where a delivery truck was used by the vendor in that capacity. And what this created was a whole new level of compliance. This wasn't a tax, wasn't a sales tax, but those companies that typically would have had compliance responsibilities for the sales tax in those transactions are the targets for this fee. And so there was this sort of assumptive policy that the vendors would be able to handle this in their billing process. This is actually very typical of Colorado historically, to draw conclusions about imposition of taxes or fees, and they typically ignore the fact that a lot of the vendors operating in their state are also operating in 40 other states, and that the compliance responsibilities, while they may not be onerous if you're only in the state of Colorado, they are onerous once you start to extrapolate that across other states and have other responsibilities. So, you see this start and stop kind of routine in Colorado as a result of this. We saw it with well, we'll talk about this in just a little bit, their sales and use tax remote seller policy and the framework around that. But back to the delivery fees specifically, when this was first introduced and required, there really weren't any limitations. Everybody that had this sale responsibility had a responsibility to charge and collect this fee. The other thing that was required initially was that the fee be represented or reflected on the invoice to the customer. So there were two levels of compliance that had to take place there. What is new, and this is new since our last year's Hot Topic presentation, but it is effective retroactively to 7/1/2023, is that there's now a bright line test or an exclusion. If you're under $500,000 in revenue in the prior calendar year, you're not obligated to collect the fee on any of your transactions. The other thing that was changed was that you no longer have to reflect the fee on the invoice to the customer. And that was a real challenge for a lot of companies, is just getting their systems, their invoicing systems, to reflect the fee, to add the fee, because it was a unique fee relative to the way sales tax is applied to transactions. So there was a little bit of relief provided here in the last 12 months by Colorado along the lines of the delivery fee. It's not going away, it doesn't appear. And to the extent companies prior to 7/1/23 fit this criteria, there's no opportunity to recover that tax that might have already been reported and paid, even though you might have been under that $500,000 threshold. So the update here is a little bit of good news. Colorado adjusting their principles, adjusting the framework of that delivery fee to the benefit of some of the smaller companies out there. At the same time, we see an evolution with this delivery fee concept in another state, that being Minnesota. And effective 7/1/24, we're going to have another delivery fee implication. This one has a little bit of a different spin. It's a $50 per transaction fee on sales of tangible personal property in excess of $100. Now, it does not matter that the property is taxable or exempt. The fee applies as a transportation fee or delivery fee. So that $100 could be representative of both taxable and non-taxable activities. And again, this is one of the areas that makes this a little bit challenging for vendors. The other good thing, if there is a good thing, in this Minnesota legislation is there's a $1 million bright line test, meaning if you have less than $1 million in gross receipts in the prior calendar year, you don't have an obligation to comply with this delivery fee. So other states have now started to evaluate the aspect of implementing a similar delivery fee. Illinois and New York are both entertaining that potential. So stay alert. There could be some more of this happening as time progresses.
Yeah, Jeff, I think just as a reminder that even if you're not required to charge this delivery fee, it's separate from any sales tax imposition. So the $500,000 exclusion in Colorado is above the economic nexus threshold, I believe, in Colorado of $100,000.
That's a great point. Yeah,
you still have to collect the sales tax in that scenario.
So moving on, we're going to talk a little bit about the Wayfair decision, economic nexus thresholds and standards. and maybe a couple of other things here that might be of interest to the group. As we all probably know, but I'll just kind of do a quick revisit. In 2018, we had the Supreme Court agree with the state of South Dakota on the constitutionality of a economic nexus threshold for sales tax purposes, meaning that if you made sales in excess of a certain dollar amount into a state, regardless of your physical presence or lack thereof, that state could impose its taxing authority on your business. We're pretty far down the path, 6 years, 7 years later now, dealing with the economic nexus thresholds. But what's interesting is when these were initially introduced or legislated by each of the states, a number of the states chose to impose both a dollar amount threshold, most of those being $100,000 in a 12-month period, and a transactional threshold, most of those being 200 transactions in a 12-month period. And when I use the term "and," I don't mean that you had to meet both thresholds. It's actually or. In other words, you either had to have $100,000 or more than 200 transactions in that 12-month period. So this was actually the initial legislation that South Dakota introduced back in 2016 that led to the Wayfair decision. And it was South Dakota that a year or two later, when maybe it was last year's Hot Topics, where we talked about South Dakota had since repealed that 200 transaction threshold. And a few other states have done so along that timeline. This most current year, we see two more states that are making this wise, in our opinion, wise decision. And that is Indiana and Wyoming, which had this 200 transaction threshold, have agreed to repeal that. Indiana's went into effect at the end of March, and Wyoming's will take effect July 1. So no longer do you have to consider that in determining whether you have to comply, register, and meet those requirements. Another thing that I kind of started down a path of talking about in that last slide is Colorado, and this is a revisit. This is something we talked about last year as well, but we're coming up on the deadline. So we're eagerly anticipating, again, more improvements to Colorado's infinite wisdom in how they deploy tax theory, tax practices, tax processes, and requirements. In this particular case, what we're talking about is the economic nexus standards, once introduced, had an impact both at the state level in Colorado as well as the home rule city level. And when I say home rule city level, for those of you not familiar with that term, Colorado has about 73 cities that self-administer their own sales tax. They actually have their own ordinances, their own applicability, and their own compliance mechanisms. And so when we ended up in an economic nexus threshold in Colorado, what happened was those home rule cities adopted the same legislation, essentially. And they said, if you have $100,000 in sales throughout the state of Colorado, we deem you to have Nexus in our city. So to the extent your sales did take place in our city or were destined for our city, we are going to require you to register and comply with our city-level sales tax rules. In doing so, they did try to do something beneficial, so I do want to give them some credit. And they established SUTS, S-U-T-S, which is a sales and use tax system for purposes of remote sellers who had triggered economic nexus, being able to report their sales across all 73 of those cities. Now, not all 73 cities came on board with SUTS. I still think there's a few outstanding. So it's been an evolution in that respect, but it was intended to give vendors, remote sellers, a better way to report and remit their sales tax across those home rule jurisdictions. The problem was it wasn't well thought out, and as a result, it was a challenging product for anyone to use. It was difficult. It was so difficult, there were a lot of complaints, and ultimately the state stepped in and said, look, if you guys are going to play this way, you've got to get this thing figured out. It's got to work. It's got to be effective and efficient for taxpayers to use. So they actually put in legislation that they had to fix it. I say fix it, not suggesting it was broken, but I think it had there was a lot left to be desired and a lot of opportunity. So that's still going on. I think we have seen some improvements already, but effective 1/1/25, we expect that to be fixed. So we'll hold our breath, see what happens. Something else that's kind of interesting, and there's nothing that's happened in this regard yet, but when we think about sales tax at the state level, there's 45 states that have a state level sales tax, plus the District of Columbia, or DC. We kind of treat DC as a state in this regard. There are 5 states that don't have a state sales tax, those being Alaska, Delaware, New Hampshire, Montana, and Oregon. Alaska is now considering a potential state sales tax. The initial discussions have been around a 2% sales tax. It's intended to try to relieve some budget shortfalls. Don't know and can't speak to the political atmosphere in Alaska and whether or not oil drilling or oil supplies have anything to do with their budget shortfall, but maybe so. But in any case, it's an interesting discussion and something that's probably worth paying attention to. We understand 2 things. Number one, Alaska has home rule cities as well. So there's already a number of cities in Alaska that do have, similar to in Colorado, their own ordinances imposing sales taxes on tangible personal property and certain services. We also know that outside of the larger cities in Alaska, there's not a lot of metropolitan activity. So there's a lot of space out there, and it's such obviously a distance from the continental U.S., or at least the way I think of our continental U.S., that most companies don't have a ton of business up there. So I recognize that may not impact a lot of you on the call, but I think it's something worth noting and paying attention to. Interestingly enough, Alaska's cities have formed a coalition, and they do have an economic nexus threshold. Even though the state doesn't have a sales tax currently, those cities have gotten together and said, if you exceed $100,000 in gross receipts in Alaska as a state, you have an obligation to comply with our city level ordinances and sales tax requirements. So it's not void of sales tax there today, and it might just get worse. Lastly, there's just a reporting mechanism or a reporting change that we see. And again, I think that it goes in a positive direction, and that is Alabama has expanded the threshold for purposes of what we call prepayments. And I'll kind of just talk about this real quickly to give you a picture of what this means. And this isn't the only state that has these. Certain states have legislated, or at least their administrative policy has allowed them to look at very high volume vendors, and think of a Walmart that's got thousands and tens and maybe even hundreds of thousands of dollars in sales tax running through there on an annual basis in any given store. And what some of the states have said is, look, the traditional filing periods are such that you're getting to hold that tax for upwards of 45 days. If your filing frequency is monthly and our due date is the 20th of the month subsequent to the date the tax was charged, that vendor gets theoretical use of that money, and the state loses use of that money for that period of time. So what some states did a number of years ago was to say, look, if your revenues or if your tax exceeds a certain dollar amount each month, we're going to actually put in a requirement that you have a mid-month payment obligation, and that's what we call a prepayment. And it's typically predicated either on a percentage basis based on last month's sales, or it could be based purely on this month's sales, similar to an estimated tax payment you might make for income tax purposes. But there are thresholds, bright line tests that are in place to determine when it is time for you to comply with that law and when you don't have to. what Alabama is saying that as of 10/1/2023, instead of there being a $5,000 threshold, there's now a $20,000 threshold. So it should eliminate some of the burden and pressure on some companies that were otherwise required to make these prepayments or early tax distributions back to the state. So again, a piece of good news in some of this with Indiana and Wyoming removing the 200 transaction threshold, and then Alabama kind of giving some companies a little bit of a break on those prepayments.
And Jeff, I'll just make a comment on those economic nexus thresholds, because where you referenced the 2 states here, I think there were as many as 10 states, including South Dakota that you mentioned before, that repealed these transaction counts in 2023. So it's somewhat of a trend. And I think what's interesting is when you do kind of look at the South Dakota versus Wayfair case, the Supreme Court's perspective was if as long as this is quote unquote simple to administer, it's not a burden on the small business, then this kind of remote seller concept works. It makes sense. You can enforce it. So, where that argument starts to fall apart, and I don't think there's actually been a challenge on this, but I think this is what the states are concerned about. Where it falls apart is the 200 transactions for $1 a piece. And are we really going to require a vendor to adhere to these sales tax rules for a $200 revenue activity in the state? That's burdensome on that quote unquote small business seller. I think it could be challenged if anyone wanted to, but I think that's why we're seeing some of these nexus thresholds in terms of the transaction counts be repealed. Similarly, in terms of these retail delivery fees, again, somewhat of a trend, not as substantial as what we see in terms of the repeal of the transaction counts. But if you start looking at, some of these states jumping on board with these retail delivery fee kind of concepts, it's a relatively, I don't want to say easy. It's whenever you add a new tax, consumers tend to get worked up about it. I think these retail delivery fees somewhat fly under the radar a little bit, and I think politicians might think it's a little bit easier to pass these retail delivery fees as opposed to an additional sales tax. So probably something else that we're going to see more of in the the next 12 to 18 months, I would think.
Good points. Just touching on a couple of states and some rate changes. One of these we talked about last year in our discussions, but it's kind of a reminder because there's a staging or a scaling effect in Alabama where the sales tax rate on food at the state level is being reduced, and effective 9/1/24, there'll be another step reduction down to 2% from 3%. The others that did take effect in 2023, but after I think we did our hot topics for 2023, Oklahoma has taken a stance and implemented, basically eliminated the state level sales tax on food. They're calling it a 0% rate, which is kind of similar to the way Canada talks about things from time to time. But essentially, it's a no tax on food, state level. Does not affect local levels, although the locals can adopt legislation similar to this or ordinances that can serve to make it a completely exempt. But this particular topic at this point is really just focused on the 3%. I'm sorry, the fact that Oklahoma's state level sales tax has been taken away on the sales of food.
Yeah, and I think what you see more often than not from a tax rate change or update perspective is more at the local level, whether that be the city or the county level. Just something quickly that I looked at since we're here in Georgia. I wanted to see if there were any Georgia sales tax rates that have been changed recently, and effective April 1st, of this year, just last month, there were 8 Georgia counties that changed their sales tax rate. So while there's not a lot of state level changes from a sales tax rate perspective, you see a lot of these cities and counties when you're dealing with 10,000, 12,000, I don't even know how many total jurisdictions there are, but when you're dealing with 10,000 to 12,000 jurisdictions, there's always some type of rate change that's going on, typically at the county or city level, that you have to be more, I don't want to say more aware of, but definitely aware of, versus just a state level change. Again, I think it's difficult to pass a state rate, probably more challenging to get a state rate approved as opposed to just a local city or a local county that maybe they advertise it or bill it as a additional fund for schools or road improvements in the local community that people don't fight as much as a state rate change.
Good points. So last topic for today is not so much a change in legislation or law, but just a topic that is starting to gain more, at least, interest across a lot of the companies we talk to. Brian's had some exposure to this even internationally, but it has to do with non-fungible tokens. Basically, we're talking about commerce in a way that's very different than we're all used to. We get into cryptocurrencies, blockchain type transactions. I am not in any way, shape, or form an expert on any of that, but we now are starting to see some states addressing potential sales tax implications via these currency options. And in the non-fungible token arena, we've seen a few states that have gone to some effort to at least advise that, to the degree the non-fungible token is based on an underlying product that is of tangible personal property or is taxable or subject to sales tax, then the sale or purchase of the NFT is potentially taxable or likely taxable. So we start to see this association between the framework of currency and this association with the underlying products driving some potential tax implications. What I would argue is it's probably not any real change in legislation. It's not changing the taxability of products and services as they exist today. It's simply addressing the fact that sometimes the compensation or the methodology of payment is different. And this is something that's existed in other ways throughout history. Trade-ins always had an implication as to how you valued the tax basis of something. So we've always had some aspect of boot, some form of boot that was used in a transaction, and whether it was an exchange of services for goods or vice versa, those had underlying sales tax implications as well. So I think this is an initial stage of we're starting to see some states advise or address it.
Yeah, and I think Jeff referenced a handful of states, and I'm going to do a little bit of reading here because I don't know these definitions just right off the top of my head, but a few of the states that have issued some specific guidance, Washington State is one, and all of these have, as Jeff had referenced, kind of this some form of a look-through approach in terms of what's the underlying, not necessarily value, but what's the underlying item that's represented by that NFT. So Washington defines it as the taxability of the transaction depends on whether the underlying good or service is taxable. So not necessarily a surprise there. Wisconsin is another one that's provided some specific guidance on these NFTs. Very similar. They've taken the approach that the NFT may be taxable if the underlying product, good, or service is taxable in Wisconsin. And Minnesota has come out with the similar guidance, again, using this kind of look-through aspect of what does the NFT represent. Pennsylvania is the only other one that we've seen that's provided any type of guidance or policy on this. I don't want to necessarily tell you to assume that every state is going to look at it the same way in terms of the underlying product, what is represented by that NFT, but at least the ones that we've looked at or that have come forth with some type of guidance, that's what they're doing from an NFT perspective. Looks like we might have a question or two here. So I'm going to pose the question to Jeff. Let's test his knowledge here. So we're going to talk about the Minnesota retail delivery fee. Are you aware of any guidance that says how that has to be presented, on the invoice or on the, within the shopping cart? Does it have to say this is the Minnesota retail delivery fee instead of just like a generic delivery fee?
Yeah, what I do know is that Minnesota actually adopted something similar to what we see Colorado adopting, and that is that the vendor can assume the liability. So my recollection on that is that it doesn't have to be represented on the invoice, that they have the option of just absorbing it. That was the challenge some of our clients, in fact, had with the Colorado delivery fee. They were unable to get their systems to adequately present it on the invoice. So it's my recollection that Minnesota got ahead of that and actually already addressed that and indicated that it was not going to be a requirement.
For Alabama and Louisiana locals, do they follow similar economic nexus rules as the Alaska cities? Just wondering if economic nexus, if it's reached at the state level, if it is required to file the local parish or Alabama city counties as well.
Yeah, good question. And the short answer is yes. They look very similar. So Colorado, Alaska look very similar also in Alabama and Louisiana. So what that means is any of the home rule cities in those states would assert you have nexus in their city to the degree you've exceeded the economic threshold at the state level. And of course, that's predicated on you making taxable sales subsequent to reaching that threshold in those cities. It's interesting what Louisiana did because they kind of did a bait and switch. I felt like Illinois did a little bit of the same thing where they started out with a more generous approach, meaning they either established sort of a fixed rate that you could use across the state so you didn't have to differentiate the rates between the parishes in Louisiana. Illinois did something similar in that usually, or historically, I should say, if shipments arrived into Illinois from points outside the state, only the state tax was imposed. The local tax, the vendor was not required to charge and collect the local tax. Both states kind of reversed their decisions within about a year of deploying their remote seller rules and said, Louisiana said you have to charge the rates by parish, and Illinois said you have to include the local sales tax rates on your transactions as a remote seller. So both of which were not, I don't think, received very well by the general public, particularly remote sellers. But that's a longer answer to your question. Yes, those states do have similar policies.
And I'll also add, assuming you're a remote seller in those two states, Alabama and Louisiana, they have at least done some level of simplification from a filing perspective. So traditionally in those states, if you had a physical presence, you may have to file at the individual parish or the individual city level. But being a remote seller, not having a physical presence in the state, only having economic presence, you do at least get the benefit of filing that kind of centralized single return for Alabama and Louisiana. Let's see. I think that was all of the questions that we had. Certainly, if you have any other questions, I think my contact information is on there. Feel free to reach out to me directly, and happy to engage with you one-on-one for some additional details here. But thank you, everyone, for joining us. We appreciate it. Hopefully, we'll see you the next time around.
Thanks, everybody.
This has been It Depends, with another episode explaining the complexities surrounding sales and use tax. See you next time.